Good afternoon, everyone. This is Joe Gordon with Gordon Asset Management, and today is Tuesday, June the 9th for our weekly market update. Just to get a few things, housekeeping out of the way is our weekly disclosure. We're not giving any investment advice and tax advice or any other kind of advice, just opinions of the firm and of me personally about what's going on out there from some great data sources that we seem to be able to put together every week. Okay, so you can always sign up for updates at wealthqb.com. And again, the series, The Bull Market is Dead, or is it? And we'll see what's going on here in a sec. So when you really look at it, the encouraging thing in this slide is that you see that the daily new cases in the United States of coronavirus is trending down from the high of 30,000 to 20,000 per day. The 3-day moving average is this blue line, which you see is on a decline down. That's positive even as the economy has opened up, at least in about half or more of the states. This slide in particular just shows you basically the containment is stalling in the U.S. with new infections. And we expect there to be more cases for two reasons. One, the economy opening up, and two, which most of us witnessed last week with all the protest and rioting, is there was no social distancing whatsoever. So let's see what the market's done in spite of all the noise. You can see as of yesterday, the S&P is actually positive for the year, just barely over zero. That's quite a trip back from negative 33% at the bottom. The NASDAQ is positive. That's dominated by your tech stocks. Up 13% year to date. People will remember 2020 as what crash. And then the Russell 2000, which generally is the index that goes down the farthest, the quickest, has rallied to be down just under 8% year to date. You can see all of these graphs, the green one being the Russell 2000, NASDAQ orange, and the S&P is the Barclays Ag are positive at 2.5%, and then the purple, the S&P 500. So that obviously is positive and good news for most investors in any asset class. So as we've stated in prior updates, there's 5 stocks in the S&P 500 index that are over 20% of the market cap weighted index, and they really are the rising tide that's pushing the whole boat up, so to speak. And those are Facebook, Amazon, Apple, Microsoft, and Google. Over here graphed, you can see they're up 15%. The remaining 495 companies are down 8%. So you can see there's quite a disconnect. And many pundits are saying that for the market to continue to go from here, you're going to have some breadth in the rally. That means other stocks in the 495 are in the aggregate are going to have to start doing better. PE ratios, again, this is good aggregate data for the index. It is up in nosebleed territory on the far right, essentially over 21. However, again, if you peel back the 5 megatech stocks, you really see those at a PE ratio of about 28 to 30 times earnings. And then you see the other 495 at around 16 times earnings. So I'm really not concerned overall with the aggregate of the index, again, because 5 stocks make up over 20%. So do valuations really matter? This is something that does concern us. Obviously, people know this as the hope rally. We call it the Fed rally with all the liquidity infusion. But there is a huge gap between the index and corporate profits after tax. It's the largest on record since data was kept. And this data goes back to 1970. You can see a huge gap leading up to the tech bubble bursting. You can see an even larger gap right here to the far right between earnings and where the index is trading. So normally, when things do normalize, you see the third bullet, either earnings are going to have to decrease, earnings have to increase, or the index is going to come back down over time. We'll see and see how quick the recovery goes. Many of our clients are asking us, hey, should we sell in May and go away? I mean, this has been the best rally ever in the shortest span from the global shutdown. And we've been getting this question a lot in the last week of May or so, and even last week. And if you look at this chart, what's interesting is that the sell in May go away really seems to have some credibility, because if you sell in May and then you go away until November, you can see the highest returning 6-month period is the November to April period at average over 7%, with data back to 1950 up through 2019. If you look at the next best, it's October to March, and then the next best December to May. So it clearly shows that the S&P's performance is during those 6-month periods is much better than if you did it the opposite. And that is May to October, you're invested. The average is 1.5% a year. But to the far right, what is enlightening is that 64% of the time, even the May to October has positive numbers, but 78% of the time, the November to April does as well. So obviously, sell in May, go away. We'll be looking at this in December and see who was right. But clearly, conservative investors are taking a little winnings off the table. So here's something that's interesting. Hedge funds, they've been net sellers since late April. So they missed the entire May bubble up. And generally, I think most of the hedge funds folks that we know of and we're listening to got it totally wrong. Stan Druckenmiller was on CNBC yesterday talking about how he missed the whole thing. So a lot of the billionaires were spooking people in mid-March to the end of March, and they were not invested. And then now that's buyer's remorse, or seller's remorse. But if you see that, a lot of hedge funds, I wouldn't say they're all that smart. Now we learned yesterday or Friday that we actually were in a recession in February. And I have to admit, when the market hit its all-time highs ending February 19th, a lot of the data underneath that was lousy. So now the National Bureau of Economic Research has said, oh, we were in a recession even before the global economy shut down. It's the fastest they've ever declared this since they began doing it in 1979, which kind of makes you wonder. But nonetheless, it is what it is. So obviously, in the jobs report last Friday with 2.5 million jobs created, every pundit was saying minus a million. So they missed that totally. And there we are. The non-farm payroll rose by 2.5 million in May, which again, everyone got wrong. So you can see the graph with the decline here steady, and then you see the huge uptick as of last week. The unemployment rate was at all-time lows down here earlier this year, and now at 13.3 is down from 14 and change. That really says a lot that things are reversing. Again, state economies are opening, and things are actually going to start improving. You can see here employment rose in leisure, hospitality, construction, education, health, services, retail, and then also government employment went down. The real story, though, is not the 13.3. Is basically you've got 35 million Americans still getting unemployment. Many of those are making more money being unemployed than when they were working. That's the lower income earners in that data point. And the other thing to look at is that the unemployment headline number is the U3, but the U6 really captures those that are underemployed. And that number is really cratering or pushing up towards 25%. And then that would be someone that lost their job making 100,000, let's say, and now they're reemployed. The only thing they could find is at 60,000, and they're holding on for that for dear life because they probably have great benefits or have some benefits, but still clearly they're underemployed. All right, let's look at sectors. We looked at this last week a bit, and it's just getting better and better. If you were in energy, you are still down 21% year to date if you were fully invested. However, if you only have been invested since the quarter began April 1st, energy's up 59%. That is by far the best performing sector this quarter. And a lot of people, I was one that was investing in energy early personally because I just thought, energy's priced in early April as if no one's ever going to drive a car again or no one's going to fly in a plane. Clearly, it was at a historical bottom. Financials also still down 12% year to date, but up 28% this quarter. And Mike Mayo, who's a well-known analyst on banks with Wells Fargo, was on CNBC yesterday. And interestingly, he said a lot of people got the bank call wrong because they are thinking banks like the financial crisis when their balance sheets were weak and they really were in trouble. This time is totally different. The bank balance sheets are incredibly strong. He did say that bank cost structures will come down at an accelerated rate simply because a lot of people were forced to use digital banking, and he says accelerated the usage ramp up of digital banking by 2 to 5 years. So there'll probably be a lot more or a lot fewer branches going forward. Otherwise, if you look across here, you can see pretty good returns in every sector, nothing negative, all double digit. And in particular, real estate is starting to climb back. Year to date, just down a little bit. It's had 2 good weeks. Healthcare had already been good, but obviously the clear leader year to date is technology, and then communication services, which involves a few technology names who used to be bundled in the technology sector, but both of those sectors having great quarters as well. If you looked at factor of performance and look at the market from '05 to 2019, clearly momentum is the best factor, and that's where you get a lot of that in technology. Small cap has had the highest trading volume. If you look at year-to-date, cyclicals have actually had the highest performance, followed by momentum. So looking at market recap, is we talked about year-to-date performance outside the U.S., the Europe, Australia, Far East, developed markets down 9%, emerging markets down almost 10%, and then the global ag bond index up 2.42. So still, the news is much better in the U.S. than it is outside the U.S. as far as equities are concerned. Some new things developing, many of you probably have heard about, is are we entering a new Cold War, not with the Soviet Union this time, since it doesn't exist, but with China. And so we'll just have to see how this evolves. But clearly you can see here that the White House issued a statement to Congress and basically talking about undermining our interest, our national interests are being compromised. And there's a lot of rambling on the various news outlets with various politicians, both in the House and the Senate, about what we have to do. So when you look at trade with China, a lot of people feel pretty vulnerable. If 90% of your U.S. antibiotics are made there and 80% of the active ingredients in other medicines, 95% of rare earth minerals, think technology, and 73% of global lithium battery cells are made there, that's kind of scary. The other stuff, not so much that important, but clearly there's been a sellout to China by our politicians, and I'm getting political, both sides of the House, all in the name of money. China clearly benefited. A lot of our companies had much lower cost structures because of labor costs, but then some of the national interest items are coming home, especially in pharma. People are wondering, are we going to have inflation with all this money printing by the Fed? But if you look at inflation data, you can see where inflation really was high. Headline CPI just under 15% back in 1980. Those of us that were around in business remember those days. That is the scariest thing of all. It's much worse than deflation. We're kind of in a deflationary era, and that's led by the disruption in technology. Technology is very deflationary. You can just look at what you're paying for computers as a bellwether of that statement. But there's nothing there yet. We'll see if it picks up. If we do see any inflation, to me, it's going to be something more in the supply chain. You can think of beef shortages, or meat processing plants have shut down because of COVID infections, etc. Could be temporary. Here's a graph that really I'm going to say nothing about other than basically year-over-year headline inflation around the world, but you can see there's really no inflation perking up. If it's blue tinted, there's nothing. It's either steady, even, or down. If it's red, it's where you may see some inflation going forward. So let's look at commodities. What's interesting in the left chart is you can see the range bound of each of the Bloomberg index, but then livestock, natural gas, agriculture, crude oil down to $11 a barrel there in April, currently at 38. You can see the energy rebound there. Industrial metals, silver, and gold. The only one that's positive year to date is gold. So when you have a global shutdown, all the other commodities generally are in less demand, and you'll generally find this to be the case, but things are starting to change. Gold prices are on a path to approach where they were in 2011 at their all-time high per ounce, other than back in the early 80s. And you look at commodity prices, inflation, the commodity index, and headline inflation kind of are trading in tandem. So are we out of the woods? David Rosenberg, one of our favorite economists who writes daily missives about this. He's apolitical, he's investment, he just reads the tea leaves of the data. He really thinks the equity market is totally overpriced, and he just is very amused at the activity and people chasing the high beta names, especially in the hospitality industry. And then also, you see the Fed Reserve Beige Book, pessimistic about the pace of the recovery because nobody knows. Jamie Dimon, though, who's probably someone most people listen to when someone on Wall Street speaks, he says, we think we're having a rapid recovery, and they're just looking at that from the data. So if the recession ended today, this would be one of the most impressive recoveries of all time, going back to the Depression. And that's really, really hard to believe, but that is the case. And it's just behind the one back in 1981 when Reagan came in to power in the White House. Goldman Sachs, they believe that we're already at the high target range of where you're going to see stocks end the year 2020. So that gives some argument to the sell in May and go away type of trade. But at any rate, that's them. That's a powerful investment bank, a lot of smart people, but they don't always get it right. And then otherwise, and you see this slide, we've had it in before, is tracing stock market recovery from various pandemics. And you can see here going back to HIV in the 80s, and then you got SARS in 2003, the swine flu in 2009, cholera, then MERS, then Zika, then Ebola, and then now the coronavirus. And still, you can make money in any market. So the last slide today is basically, we were looking at what a lot of people are advising. This seems to be one of the more sensible approaches. And JP Morgan has put out, and this is public information, 3 sleeves: equities, and then 2, protection and guaranteed income. Obviously, folks with Social Security, pensions, or annuities, that's guaranteed income. Bonds, you have pretty much guaranteed interest unless the underlying company gets in trouble. And then you've got non-correlated assets, things that zig when these other ones zag, especially stocks. So clearly people want to stay with high quality companies, strong balance sheets that possibly are immune to recessionary forces. And again, there's no better area to look than companies like Costco and Walmart and Target during this COVID crisis and shutdown. Consumer staples, things you can't live without, food, and then technology. Bonds are at historic low yields. So generally, unless we have deflation and it stays, you're gonna see the low yields persist. We see an uptick, that maybe things are heating up in the economy, which might not be a bad thing. International markets have some good opportunities, but you have to be selective. So good active management is going to make the most sense there. Also know when you invest internationally, typically those indexes are very underweight technology relative to the US. Also, non-correlated sleeves, hedged equity is a great area to go. Private equity is a great area to look at too, as private equity firms have up to $3 trillion in cash they're trying to deploy. And many private equity firms do invest in distressed debt. And then you've got gold. So gold's about the highest it's been since 2011. It's pushing up that way. If we see any uptick in inflation, you'll probably see a huge demand in gold and gold miners. This is where active managers shine. The indexes are not going to save you if things reverse. And again, like we said, the S&P with 20% of the market cap in 5 stocks, that's something to keep an eye on. And the PE ratio in emerging markets is basically the lowest it's been in 40 years. So it just tells you most investors are shunned emerging market equities. That may be time for a look. So with that, this is today's update, and appreciate your attendance. And feel free to reach out to any one of us here at Gordon Asset Management if you have any questions. Otherwise, we look forward to continuing the conversation. Thank you.